What's up, everybody? It's Jamel Gibbs, your family-oriented entrepreneur. Welcome to the Business and Investing Podcast. Listen, so we had a fantastic infinite banking podcast a few weeks ago with Deandre, and by way of your feedback, we wanted to get Deandre, and you guys requested my man Reggie Briscoe as well. So we're gonna talk to both of these guys today, and we're gonna tie in the infinite banking with the HELOC strategy today. We're going to talk about that in full detail, and we're going to see how that ties into real estate as well, which is exactly what you guys are looking to do. This is a wealth generating podcast. It's a wealth strategy we're talking about. It's a passive income strategy. It's a put money in your pocket strategy, and that's exactly what we're going to get into today. People need to hear this information. So in order for them to hear this information, we need your support on this channel. We need your support on this video. You got to like this video. You got to share this video with everybody you know. You got to comment. That's the only way YouTube is going to pick this video up. And don't be selfish. We're not being selfish with this information, so we don't want you to be selfish. We need you to like this video and push it out and tell more people about this strategy, because this is definitely a life-changing strategy. So without further ado, let's welcome my good friends, Deandre and my brother Reggie Briscoe, to the call. What's up, man?
What's happening? What's happening? How you doing, man?
Doing good, man. So look, Deandre, I know you were on the last episode with me. Why don't you tell everybody a little bit about yourself, just to recap for those who didn't see that episode?
So, as I was bringing out, I'm an insurance agent, broker for two different firms, manager, and have been doing that for the last 7 to 8 years. The cool part about why I got into what I was doing was just the overwhelming amount of appointments that I was having in reference to dealing with teachers in the school system and just learning about them always wanting access to money. So that's kind of what piqued my interest in trying to figure out what are the different ways to be able to do this to help them to figure out how to fix these little quirks of, yes, I want to invest, but life happens. Mm-hmm. And so I just tried to figure out, okay, well, what happens when life happens? And so that's how we got to this point right here.
Cool, man. Now, you guys knew Deandre from the last video. I want you guys to get to know Reggie Briscoe. Now, remember in the last video, we talked about Reggie a little bit. He was able to pay off, 2 houses in 3 years?
Yep.
2 houses in 3 years. I know you guys want to hear that. That's a fact, right? So we're going to talk about how he did that, but why don't you tell everybody a little bit about yourself, man?
Well, I've been a technology consultant for a lot of the major computer firms for over 40 years. I know I look young. Well, but I've been doing that for a while. That's my real job, my main job. But in these latter years, I've been spending a lot of time learning how to leverage my money because, of course, in the early years, I didn't save like I needed to. So later on, it's like, okay, what can help me? Real estate, right? But I didn't have any funds to do anything.
Got you.
So then I had to do something, and I came across the HELOC strategy, which we'll talk about in a little bit. But that HELOC strategy and having a HELOC or home equity line of credit saved me. I didn't want to take my mortgage into my 60s, mm-hmm. especially after retirement. But right now, I'm in a position where I don't have to worry about that. 5 years ago, I was in a lot worse position.
So let's put that in perspective. So you're approaching 60 years old 5 years ago.
Yeah.
We telling your age right now.
That's okay. That's okay.
So you're 59 years old. You still got a mortgage on your house.
Right.
And cause I know the story a little bit, but
right.
Mm-hmm. So you're approaching 60. You didn't want the mortgage anymore. You still had a mortgage.
Still had it.
And you were able to pay it off in 3 years.
Actually had 2 mortgages.
Two mortgages.
I used to live in Baltimore, and I had my home that I've had for like 25 years, mm-hmm. and refinance, never pay off. Yeah. That's just the way that goes. Not knowing how the system was working me, right? Mm-hmm. Then, and that was those regular mortgages, just refinance into a new mortgage. Of course, you lose your time and your investment every time you do that. But when I came down here, I came down here for personal reasons, and I had to buy another home. I bought another home. I rented that one out up there. It was carrying itself, sort of, kind of, but I still had the mortgage here. And now I was 59, and having two mortgages that were going to kill me, in a sense.
Mm-hmm.
I was going to
Yeah.
I was going to retire and go to my grave having two mortgages, and it was just not something I wanted to do.
And you didn't want that, man. So you did something about it, and that's exactly what we're going to figure out today. So if you approaching 60 years old, if you're 40 years old, and I'm 41, if you're Deandre's age, he's in his mid-30s, it doesn't matter what your age is. The whole point is this can be done, and we're going to talk about that strategy today. Now, just to give everybody a brief overview of what we talked about with the infinite banking. Let me tie this in real quick. So basically, what you're gonna do with the infinite banking strategy and the HELOC strategy, you know what? Why don't we talk about the infinite banking first, and then I'll tie it all in later.
No problem. So, if you watched the last podcast, for sure, you definitely want to check that out. I get a pretty detailed in reference to it, but the reason why you're going into an infinite banking policy, and I can't stress this enough, is because you want access to capital to do something with to earn more money.
Right.
So if you don't take anything away from understanding why you're doing infinite banking, take that away from it, because there's many people who get excited about liquidity, but liquidity means nothing unless you use it to increase your own value.
That's right.
You just have a lot of money. It doesn't do anything for you. So we want to make sure that that's clear first. And the way that we're achieving that is through, obviously, a mutually owned life insurance policy that is high cash, low death benefit. And we're combining that with the aspect of actually taking the expenses out of the policy. So we make it a 90-10. So one of the things I didn't touch on too much in reference to that 90-10 or why it's structured that way is because of what they call paid up additions. So paid up additions, and this is a easy way to explain it, but a lot of people have no idea that a whole life insurance policy can even do this. But in essence, what it does is it takes the policy and it says, instead of diverting the payment to base premium or to the cost of my regular life insurance, I'm going to purchase term insurance inside of the whole policy. And that's how it boosts up to lead to the regulations and being able to fall in the right place. So it gives you a great death benefit while also being able to supercharge the banking function because it took away the insurance costs away from it. So a lot of people are not even aware that that happens. So, I touched a lot on buy term, invest the difference on our last podcast, and a lot of people don't even know you can buy term inside of your own whole policy. And that's really what infinite banking is doing. So it's lowering the cost of insurance so that the banking portion of it is the heavy part of that policy. And so with that being said, now you're banking and you're seeing the money in the first year instead of it happening in the 7th year. And you're also being able to take loans against that while the original amount that's there continues to grow via interest, via dividends. So the reason why those dividends are paying out is obviously because of performance of the company. And a lot of people say, well, we've heard some aspects about whole life dividends, and I didn't touch on it on the last one, but I really want to make this clear. Some say that whole life is where the insurance company makes the most money. I am here to kind of give you guys some clarity on that. Okay. When you purchase a term insurance policy, the metrics are 99% of the time they do not pay out. So how is it that a whole life is where they make the most money if 99% of the time you purchase a term, it doesn't pay out? So once people understand that, it's like, okay, well, I've been told to buy term and invest the difference. So you start to translate that and say, well, hold on, I'm being told to buy something that there's a 99% chance I'm never going to
Never going to get the money back.
right? And so this infinite banking, what it does is it says, okay, we don't mind you buying term, but buy term inside of this so that you can save actual money and allow it to grow so that you have access to capital, right? And your loans, whether it be 5 to 8%, which is kind of industry average, it's charged on an annual basis. So it doesn't compound from month to month. That's what makes the loan so attractive in comparison to others. And then the beautiful part of that is if you pay the interest on the loan doesn't default, and if you die, the loan is paid for by the insurance company, and your family gets the rest of the death benefit, which is significantly higher than
It's
what
in
you put
multiples,
into it.
right? So, how much money do you need to start up something like this?
So that's a good question. Typically, there's really no specific metric on the amount of money that you need to start it up. There's different insurance companies, different mutual companies, depending on how they're rated, so on and so forth. Some have more money than others, and so they will allow a 90-10 at a lower level of contributions.
You can always add into it as time goes on.
Yeah, there's definitely customization. So there's ways to say, okay.
So, for example, let's say somebody had 10 grand.
Right.
And they just wanted to get started with something like this. Could they do it?
Of course.
Okay.
Yeah, of course. The cool part that I really like is the customization aspect. So it's possible for you to say, okay, I want to put 10 grand into it, but I don't want to be held responsible for 10 grand every year. You could actually do that with some policies. You could say, okay, I need my base premium to be about $2,000, but I want to be able to put $10,000 in there if I want to sock extra money in there. So there's policies that allow you to do that, and that's what allows you to say, okay, I'm not going to lapse because I can always kind of change the metrics on it.
Okay, so what's the benefit of putting more than 10 grand in there?
So the benefit of putting
or even less.
Okay. So the benefit of putting more or less, really what you're dealing with is either way, if it's structured as a 90-10, every premium, technically you have 90% access to whatever you put in there. So if we can kind of understand that, it takes it from a cost and value conversation, right? Most people say, well, how much do I have to spend? And really, I shift the conversation to how much do you want to save?
Right.
Like, that's how much money do you want to have access to, and when do you want it? That's how we describe when, what type of premium goes into it.
So, for example, if somebody had $10,000 to put down on a house today, right? They put the 10 grand into the policy, and they get 9 grand back out.
Yeah. Mm-hmm.
And then they can use the 9 grand to invest.
Mm-hmm.
Versus using the actual money. They're borrowing the money back out against the policy in order to be able to do that. Yeah. And you still got your money sitting.
And you still have the cash value. So the cash value, the original 10,000, well, really, because it's a 90-10, the original 9,000 is still gaining the dividends, is still gaining the interest.
Powerful.
Right? And so the easiest way to think about it, once again, is it's a banking function.
Right.
So when you go to the bank and you deposit your money, they are receiving a loan from you. But what do they do with that money? Well, they loan it back out.
Right.
They loan it back out and they get interest on those loans, right? So it's the same concept, but it's just you taking control over it. So the easiest way to explain why it's beneficial is that I'm not telling you to do what the bank tells you to do. Do what the bank does.
And at the end of the day, you're doing exactly what the bank does.
You're doing exactly what the bank does.
But you're really borrowing money from yourself.
That's it.
So why borrow money from the bank and get, have all the headaches, paperwork, higher interest rates that you're not benefiting from? Borrow it from yourself.
Your debt to income ratio becoming worse. I mean, when you're borrowing from your insurance policy, there is no degree of reporting to a bureau. Mm-hmm. There's none of that. So you don't have to worry about your credit score changing because you have more debt out or anything. So there's many different benefits, from borrowing from somebody who doesn't have to report this and report that to another entity.
Now, I wasn't going to talk about this until the next segment, but I'm gonna just plant the seed for you guys. Think about it like this. Let's say you want to get started in real estate, and let's say you have $50,000. All right. Let's say you got, let's make it a nice round number, $100,000 instead of 50. You got $100,000. You put that into a policy. You're able to pull out $90,000 of that money, and if you didn't want to invest actively in real estate, you can invest passively. A good way to do that, let's say you link up with somebody like me, who's an experienced real estate investor, and you become a private lender for somebody like me, your money stays in the policy. But now what you're doing is you're borrowing against that policy. You have $90,000 that you can pull out, again, using that $100,000 as an example, to lend to an investor like myself, and your money is not being touched. You still get the benefits of your money sitting in that account. And on top of that, you get the profit off of the borrowed money that you took out. So if you let's say partnered up with somebody like me as a real estate investor, as a private lender, I take the $90,000 and I multiply it for you. You take the profits and you keep building up your policy. And this is tax-free because it's a loan.
Tax-free because it's a loan.
Man, you can't. That's killer. That's killer. So this all ties into the HELOC strategy. Now, there's a couple of different things I want to mention about the HELOC, and this is what I was going to mention before. I said let me kind of summarize it for you, but this is what I wanted to mention, just to give you guys a simplified overview of what we're about to talk about. So with a HELOC, if you got a house and you take out a HELOC, you can use the HELOC to fund the infinite banking policy. But, and I know where Reggie is going with this, you can replace your mortgage. You can replace your mortgage, the existing 30-year mortgage. Most people got a 30-year mortgage. If you got a 15-year mortgage, I'm just talking in general terms right now. But you can replace your mortgage with a HELOC, and all of the interest that you would normally pay to the bank is now flip-flop. When you get a HELOC, you're going to pay more towards the principal.
Certainly.
And you're going to be able to pay your mortgages down a lot quicker. Now, you got to find small local banks to be able to do this, and that's exactly what we're going to talk about. But the whole point is, instead of you getting a 30-year fixed rate mortgage, you replace it with a HELOC, and now you live off of the HELOC money. So let's talk about what a HELOC is, and then we'll tie it all in, man.
Okay, all right. HELOC. It's an acronym.
Mm-hmm.
HELCO. Home Equity Line of Credit. Right?
That's right.
So that's what it means, right? But what does that really work out to be? It's a loan, but it doesn't function like a mortgage functions. It can replace, just like you said, it can replace your mortgage. And it really allows you to see or to leverage your money in a better way than the standard way.
Right.
Normally, as Deandre mentioned, we lend, in a sense, our paychecks to the bank. And we think that they're just holding it for us. And they give us maybe 0.5%, 1%, less than 2%. And so, but they turn around now for every dollar that we leave there, they make $8, $10, some even $15 on our money.
And pay you the pennies.
The banks should be shot for that. All of them, because they function just that way.
Right.
There are some advantages.
He call it anarchy out here.
we do not support violence on this podcast.
But I'm just saying. But that's when you change your mindset as to what you're doing with your money. Let's compound the problem. Now they're forcing you, when you get a mortgage at that bank, and let me just correct a little bit something about what you said earlier. You said, did you have to go to small banks? A lot of the smaller banks and the credit unions are flexible, and they do it. But there are a number of large banks that also do that.
That's why you got to have friends that know what they're talking about. Right?
That's okay. So if you're at a major lender.
Real quick, if you the smartest person out of the group, there's a problem. Always try not to be the smartest person in the room.
That's true.
That's how you learn.
There you go. All right. So the bank forces you to segregate your money when you have a mortgage. And the mortgage, you like this point, right? Mm-hmm. It's a death pledge, right?
Yeah.
Mortgage.
Yeah.
That's what the MORT, mortgage,
death pledge.
mortuary, mortician, whatever. It's a problem because really you're saying that you're going to sign to pay all the payments for 30 years, probably. And if you don't, then you know your life is kind of involved. It's a place to do that.
Right.
But they really get the advantage of it because a mortgage is amortized. I don't know if you know what that term means, but it just means that they pay us. You sign up on your signed documents that you're going to pay a certain amount of money each month, and you think it's I'm just paying it off. But the way they have it worked out,
They're gonna make all their money for 17 years. I think it starts to flip flop 16, 17 years in.
16 or 17, exactly point. But here's what they don't tell you, right? Now you're going along, and you're paying like 90% towards the interest, and 10% of your money will go toward the principal right at the beginning.
So let's stop right there for a second, just so you guys understand what we're talking about. We're talking about mortgage amortization. Majority, let's say this is your mortgage. This is how much principal, meaning you're paying. This is how much you're paying towards paying off the house in the beginning. Yep. This is how much money is going to the bank in the beginning. Over time, it does this, and eventually it flip flops. It takes like 17 years where you start to pay more towards your principal. So really, you're paying off your house in 13 years. The first 17 years, you're giving the bank all of that interest. Right. That's how it works.
That's if you keep it for 30 years.
Right.
But here's the thing that the banks don't tell you. Statistics show most people within the 5 to 7 year period, they move.
Yeah.
They sell their house.
And
they get a new
home.
job.
Yep.
The house is too small. They got children. You know, like you got something coming, right? Got a little so that's what's happening. And so now, know that they're getting 90% for the first 5. Maybe get down like 80% after 5 years. Sell the house.
And guess what? You start all over again.
It starts all over again. So you never get down to the 17.
Yep.
Not unless, like a few people, they keep that mortgage for 30 years and they are happy. And they got one house, no investments, no backup. It's really not a smart way to use your money. But I had to learn that. Right. It took me 59 years to learn that.
So how does all of this tie into the HELOC? So just so you guys, for clarity, when you go, let's say you got equity in a home. Let's say that your house is worth, over the last couple of years, everybody's got equity in their home right now, right? Let's say that you bought a home 5 years ago and it doubled in value. Let's say you paid $200,000, now you got a $400,000 house, right? That $200,000 is equity. So you owe $200 to the bank, probably less because you had the house for 5 years. So you owe $180, and then you got another $200,000 in appreciation. That becomes equity. So now you got $220,000 in equity in your home. Equity can be looked at in two different ways. It can be looked at as dead money, or it can be looked at as an opportunity as well, right? So when it comes to that, let's say, again, $400,000 home, you could do what's called a refi cash out and pull out up to 80% of that money. So 4 times 8, that's $320,000, which will pay off your original mortgage, and then the difference goes to you. So in this case, it'll be $140,000, considering you have $180,000 left on your mortgage, right? So you can take the $180,000, or you can pull out what's called a HELOC, and rather than you paying off the original mortgage, you can borrow against the equity that's in the house. Home equity line of credit. Another thing you could do is replace the mortgage with, you can completely replace the mortgage with a HELOC. Why don't we talk about that?
That's very interesting, because the home equity line of credit allows you to be able to do exactly what you talked about with reference to paying off or replacing that mortgage, which is so very important, because when you go into a line of credit, then the way they calculate the interest changes.
Yep.
It's not amortized anymore.
Yep.
What happens is that you get charged the interest on the daily balance, the average daily balance per month or whatever, or per 2 weeks, whatever the case is. So, and that's all the interest that you pay. So in a full 30-year mortgage on a $250,000 home, you might end up paying something like $180,000 or more. I don't know why I didn't turn this off.
No, that's fine.
I'm gonna have to.
That shows his age. Listen to the music.
Okay. I started talking about how you could pay, or how over the life of a 30-year mortgage, you may end up paying almost $200,000, just in interest. Every time you sign a loan document or whatever, you have the declaration page on the front. Second page, number 2, you typically have a statement called truth in lending. And truth in lending is saying, okay, this house is worth $250,000, but you're going to pay $475
For the whole thing. They're going to charge you 2 to 3 times the money.
Right,
Yep.
at least, right. So, and all that other money is money made for someone else. You buy your house, at the same time, you buy the banker house, in a sense, right?
Right.
And you know what? It ain't even fair because they buy their house
So
first.
you paying for 2 houses.
Paying for 2 houses, and the banker's getting that house, but they get their house first.
Right.
You get your house last.
Right.
How right is that? It's just wrong.
Yeah, man.
So anyway,
So how does the HELOC? So we understand the HELOC strategy, and just for clarification again, there's multiple ways to use a HELOC. Think of a HELOC like a credit card on your house,
exactly.
right? So you can use the money. It's like a revolving line of credit, and you can pay it down. And when you pay it down, it frees up the money that you used up. It's the same exact thing, right? So if you go out and you get a HELOC against your house today, using a traditional way, like a refi cash out, let's say you pull out $100,000 out of your house, you're basically taking a line of credit against your house. And you can use the line of credit, make some money. Let's say you had a quick flip you wanted to do, and then pay the HELOC back off, and then you don't owe anything. So you keep your original mortgage payment that you already had, and then you pay interest on the HELOC as you use it, if that makes sense, right? So that's exactly how you're going to do it. But when you're talking about replacing your mortgage, how did you do that in 3 years?
What happened was I was able to actually, I came across some training that helped me to really understand all the moving pieces of it. I've also seen other people, have similar things. The thing is that once you get a HELOC, and it's a refi possibly, you can also purchase a home on it, but as a refi, they actually replace the mortgage loan with the HELOC. And then you can just use that line of credit to pay off the original mortgage, just like you mentioned, also any additional. For me, I was able to roll or consolidate my 2 mortgages into one because I had this particular line of credit. The thing about a line of credit that may be confusing because of the word equity is that people think that you need to, I only got $100,000 worth of equity in this home. Not necessarily you should limit it, because the loan is on the value of the property, not on just the equity in the home. So in my case, I had several $100,000 of money in, or as the value of the property, and I was able to draw out. I didn't have to take it out, but I was able to draw out 90% of that and use it. Well, after paying off I was able to pay off one full mortgage within that window.
Right.
And then I could just work down that at the lower interest rate. Well, let me straighten that out too, because loans, you're talking about loan rates, but that's not the only problem. That's what the banks sell. They sell low rates, and they got everybody looking for low rates. These low rates are not the only thing that determine how much of the interest you'll pay.
Right.
Time and balance
Yep.
are just as important. The HELOC allows you to affect time and balance, and it literally will make the interest rate not matter at all. You could have an interest rate of 6, 7, 8. Using the strategy, you'll pay much less of the interest.
Because you're paying it off quicker.
Yes.
Time.
Yes. You're affecting time, and because you have chunks of money to put on it, you're affecting balance.
Now, I know that you use the HELOC to support your lifestyle as well,
Yeah.
right? So you paid, let's say you're spending $5,000 a month in bills. You got a telephone bill, you
That's
got,
the beauty of it.
cell phones and food and all. How did you do that?
Well, a line of credit, a HELOC, allows you to use the HELOC like a bank. So what I did, I put all my money, all my income into the HELOC. It's sitting there.
So every paycheck that you got,
Every paycheck.
every bit of income you put right into the HELOC,
Yeah.
and then you use the HELOC to fund your life.
And I'm gonna tell you, it probably took
And
me
you-
about
and
3 months, right?
Yeah.
To get my mind around what am I gonna do. But it's really very simple. What I did was I lived off a credit card for 30 days, and at the end of the month, I paid off from the HELOC.
So hold on. So the money so there's a lot of moving parts.
Yeah, a lot of
I'm
moving
getting
parts.
excited about this, man.
yeah.
So there's a lot going on here, right? So not only are you paying off, you're replacing your mortgage, you're paying off your mortgages with the HELOC, right? But now you have the lifestyle portion of it. You got your paychecks going into
The line of credit.
the line of credit. Are you gaining interest on that money as it goes in, or how does that work?
There are no interest, a HELOC is not, it's a loan. So all the interest is being made on it is by the bank. But it's less than what you would be paying on a mortgage. And also because you can consolidate all your bills.
Pay that stuff real quick.
You can consolidate your car, your lifestyle, your loans, your educational loans, whatever they are. They all be paid from this one account. And
So it's, in essence, what it's doing, you have one payment to make,
one payment.
and oh man,
You see?
so life just becomes that much easier for you.
Yes, and the beauty of it is that, let's say, if you got a line of credit, right, and you were able to get it what's called an interest-only line of credit, the interest-only is beautiful. You know why? Because they're only going to charge you the interest against that,
The money that you use.
the money that you use.
Yep.
And you know what? Let's say that you have to move, lose your job, need to save up for something else. For an interest only, that interest only on that kind of a loan may only be $700 or $800.
Wow.
And the beauty of it is that you could take the money from the HELOC and pay the interest. You can pay the bank with their own money.
Yeah.
You understand what I'm saying? So if I lost my job and I have a line of credit, now if I had a mortgage, after a couple of months they're gonna come and take my house because I'm in default,
Right.
right? Well, if a line of credit with with interest only, let's say I can't afford to pay the $700 because I don't have it coming in.
Take it from the line of credit.
It's a line of credit. Pay them with their own money. That can go on for as long as I need it,
Right.
right? What a backup plan.
Fantastic, man. So what type of credit scores does a person need? What should a person have access to in order to be able to get a HELOC?
They should have, well, I would just say if a person has learned to be responsible with money, then he probably have everything that they need. That's in general.
Right.
But your credit scores, 650, 680 are probably on the low end. Sevens are good. Anything in the sevens, but the higher sevens are better. You'll get the better rates, whatever. But you know,
Got it. So you can actually replace your mortgage if you have as little as a 650 credit score.
yeah.
Replace your mortgage. You got to go to the right banks
Right.
in order to be able to do this.
There's few banks that will work that low. Some that won't even require that because they'll kind of analyze you with their own criteria. But if you're in the 700s, then you're pretty much
Good to go. And that's 700's middle score, right? Your FICO got to be about a 700, but it can be as low as 650, but it'll be harder to find banks that'll
Yes.
work that.
yes.
So with that being said, man, how does all of this tie in when you're talking about infinite banking and using a HELOC strategy, Deandre?
So, I mean, the cool thing about the HELOC strategy that I really like, because I started with infinite banking from a saving and consolidating debt side. So when I heard Briscoe's story, I was like, whoa. Hold on. Let me hear that again. Because, my programs, I can systematically print out, give you all types of Excel spreadsheets of when things will be paid off, so on and so forth. But usually I was averaging about 10 to 11 years as a payoff of everything, including your mortgage. So I was just like, hold on, you paid off 2 in 3 years. I need to figure out how we can do this. So the cool part is, usually when it comes to the insurance company, so one thing people need to be aware of is that the insurance company will probably approve you for up to 30% as far as a MEC limit. Now that's modified endowment contract, or let's just make it easy, how much money you want in that policy. So if you're looking at, okay, I want to fund a policy, the insurance company says, what is your income? And we don't want the policy to be more than 30% of your income. Now that could, your income could include your assets. It could include everything. So for all those real estate investors out there, I know that you lower your tax burden and you're like, well, I mean, I don't know. You could put everything that you actually make with the insurance company, including every asset that you have, and that will dictate exactly how much money you could actually gain access to and what type of policy you could set up. So now when you think about that 30%, now you look at something like a HELOC, and I'm pretty sure that typically in order to get a HELOC, just like a mortgage, they usually want you to have 3 times your, it needs to be, you need to be making 3 times more than what the payment needs to be. So, there's definitely room is almost 30% room for bending, for you to be able to have a HELOC, for you to be able to have an infinite banking policy, run it through that, and be able to make the money on it, because the beautiful thing about the HELOC is that it's access to capital. Most people, when they look at an infinite banking policy, the first thing they think of is cost. They say, oh, how much is going to cost? Well, now that can be a lesser conversation if you have access to more capital, especially if you're cash flowing more money through your HELOC. So when we look at that, we say, okay, there's definitely wiggle room there for you to be able to say, let me take this aspect of the HELOC, but let's take this aspect and actually gain interest on that liquidity that we have now. And the cool part about it is that when you're using a HELOC to pay for the infinite banking policy, guess what will pay for the HELOC when you die?
The insurance policy.
The insurance policy. So the insurance policy is always going to be worth significantly more than the property that you live in if you're using it for this banking purpose. I think in our example where I just kind of gave you some mock numbers, we looked at the first year, all right, if he funded $100,000, the insurance policy was going to provide $200,000 for the first year as a projection of a death benefit. But once it actually had $100,000 in there was 1.496 million the very next year. So is that an asset that you would want your HELOC to pay for? Absolutely, right? And so that, kind of puts it in the context that, okay, if something happens, if the ship fails, this can already just go ahead and take care of the rest of the cost of that anyways.
So just so I'm clear, you're using the HELOC in order to be able to fund the infinite banking policy.
So you have two different ways you could do it. You could use the HELOC to fund the infinite banking policy. You can use the HELOC parallel to the infinite banking policy. So if you didn't want to use it to fund it, you certainly could. That would just affect you being able to pay down the particular mortgage quicker, which, if I'm right on this, and Reggie can correct me, there's no benefit to actually completely paying the HELOC off.
Right. Because then you lose the tax benefits.
There's no benefit to being able to pay it off. You lose the tax benefits and you lose the liquidity. Now you would have to sell the home in order to get the money.
So you just want to keep the HELOC going.
This is the ultimate form of infinite banking, because what it does is it says, this asset right here, I don't need to pay it off. I don't need to pay off the HELOC. I really don't, because I want the money from it to be available to me at all times. So how can I make sure that I don't pay off this asset that gives me the value of my home? I can put it into another asset and gain the interest on it. Right? And now that asset, if something happens to me, God forbid, it will pay off the HELOC if that is what is desired. Right?
And it's going to be in multiples, which the money is going to go to your family.
Yeah, it will be in multiples back to your family. And so, when we realized, after looking at the numbers, it was like, oh, this is an incredible opportunity. Because, you were asking a question about the interest to Reggie. That was the first question I asked him. So do you gain interest on it? Because I'm thinking about infinite banking. And then we realized, okay, no, these two can marry each other. Because insurance usually is married to real estate. It is very much so in tune with real estate. And so this is just another way to make sure that, okay, I want to have access to money in my policy, and I want to have access to money in my HELOC. And even if you listen to some of the nuances of what he was talking about, living off of a credit card, we could even encourage you to get a 0 interest for 18 months card or whatnot. If it has rewards, now we are using that same $1 3 times.
Oh my goodness.
Right? And so you're gaining the benefits. Oh, you want to go on a flight for free? Oh, yeah, you'll have money for it because you've been flooding your expenses through the credit card and paying it off every month.
You got place. I'm not going to mention. You got some of these vacation places you could go on vacations for free to these exotic islands on points because you're flooding. Because you're flooding it. I mean, it just funds your entire life. If you guys can kind of see where this is going, man, it's how the rich do it. You mentioned Joe Biden paying himself a salary since
84.
84. Paying himself a salary. You sent me an article. Yeah. Who was that? It was Jim.
I sent you a Jim Harbaugh.
He's a football coach.
Yeah, football coach, University of Michigan. His situation, instead of opting into the 401k, he opted into having University of Michigan fund his retirement via life insurance.
And then it protects the university because they get their money back.
Yep.
They keep their money, actually.
Yep.
They're borrowing against their...
Yep. They actually make enough money to split the death benefit in such a way that his family would receive more
and they get
than
all
what
their
he
money
had,
back.
And they would receive every lick of money that they put into it.
That's crazy, man. This is such a powerful tool, powerful strategy. I believe just a little bit of knowledge. That's why we're providing this information for you on this podcast. Just a little bit of information where the majority of the people don't have it. It could change your situation, right? You got to stop thinking conventionally and start thinking outside the box. And this stuff is not really outside the box because the information been around since before banks were even involved, right?
Yep. That's banks. Banks were started probably at least 100 years after life insurance companies, maybe 200 years after life insurance companies.
It was funny, man. I don't know how many of y'all like. You remember Back to the Future?
Oh yeah.
Part 3.
Some of the blown up.
Yeah, Part 3. Remember when they was in the 1800s?
Oh yeah.
They showed Wells Fargo Bank in back of them, right? And I automatically thought about that. I said, life insurance policies been around before that.
Yes. Life insurance. So life insurance companies have been around longer than our Social Security system.
Yeah.
Let that sink in, right? And so once you understand, okay, why can a life insurance policy provide the liquidity that it provides? You combine the fact that the number one product that a life insurance policy or a life insurance company sells and that is advertised is term insurance. 99% of the time they don't have to pay it. Where's the liquid coming from? Where's the liquid coming from? It has to be there, right? It has to be there, right? And so when you decide, okay, I want to be a little bit different than most of the people who are deciding I'm just going to do term insurance and try to invest the difference, then you realize that there are people who have been doing this and living their entire life without having to worry about being told no from a bank. Yeah. Which is kind of big because, you know, if we don't even need to talk about predatory lending. We don't need to talk about if the bank over leveraged itself, because we know that the bank oftentimes sells mortgages that it actually can't afford. Right. We can get into a whole bunch of different stuff, but imagine being able to say, I want this, and pushing a button, and you don't need to be told no.
Bro, tons of information on this podcast today. I want to recap what Reggie was talking about. How did you pay off your mortgages, 2 houses in 3 years? How did you do that?
Primarily, I was able to get a HELOC on my rental property. Then I was able to use that HELOC to pay off the house I was living in.
The one house.
The one house.
And then you had one mortgage after that.
And then I had one mortgage after that. And then I threw everything at that. Lived off credit cards. And, but they were paid off every month. So all the interest was low interest. And the other good thing is that for what I had out, I was paying something like $750 initially for the interest part. Now I was already paying over $2,000 in mortgage.
So you just paid the extra $2,000 towards the HELOC?
Yeah.
That's it.
Directly toward the principal.
That's how you paid it off.
And it paid it on down, and it just ran it down. And then, of course, the interest came down because how they calculate the interest. After the first year, my monthly payment was something like $450.
Right.
Required for the interest only. After the second year,
because it's on a lower
only
balance.
$200.
And then you kept paying the $2,000.
Kept paying the something.
Yeah.
I kept paying everything
because your income counted as a payment.
Flow. Right. It's all about cash flow. It's all about cash flow. I had probably
and your income counted as a payment. Oh my
income
goodness.
counts as a payment. That's
my.
So for the listeners, I really want you to understand why this is so important. His income counting as a payment. For some of us, we think of, well, I don't know, I'm a little nervous about that. What would you rather have access to? Would you rather have access to the value of a house, or would you rather have access to your paycheck?
Value of a house to me, man.
Any day. The reason why we pay off a house is to open up cash flow. The HELOC is doing that before you need to pay it off.
You have cash flow.
You got cash flow.
You have cash flow.
Right?
And if you're cash flow positive, you will run that mortgage down. And so it helped me because I was able to then not pay off the HELOC, but take another part of that HELOC and purchase another property. And so now I'm running down my third property right now.
3 properties. Where's going to take you about another 2 years on that one?
Well, not with my plan. If I don't do anything else right now, maybe 2 years.
2 years.
But if my plan is
pay it off quicker.
Oh yeah.
Yeah. So that's incredible, man. So I wanted you to talk about that for emphasis purposes. We talked about the infinite banking part. We talked about the HELOC part, how it ties in together. I wanted to talk about the real estate part of it, but I think we're going to save that for the next episode. I don't want to. There was a lot of information covered on this particular episode. We're going to tie in the real estate part and how you guys can really capitalize on this opportunity. This is definitely an opportunity that majority of you listening to this can take advantage of. If you haven't had an opportunity to check out part 1, I'm going to make sure I link it in the cards up at the top. I need you to watch that so you get an overview of infinite banking. Then I want you to come back and watch this one again. Listen to the HELOC and how it ties into the infinite banking part. Then we're going to do a third one. And we're going to talk about the real opportunity that this presents for everybody watching. If you want to see a third episode where we tie it all in to real estate and how you can present the opportunity, how you can take advantage of the opportunity, I want you to comment opportunity in the comment section, and also rock that like button hard. Rock it hard, because this is game changing stuff.
It certainly is.
Right, opportunity in the comment section, and smash the like button. Get them likes up on this video. That's the only way I can tell if you're truly interested in this topic. Let's talk about mindset real quick as we wrap this thing up.
Mindset is so very, very important to this whole piece. And really, I would say that anything people fail in is based on their mindset and behaviors, lack of discipline. So what we're telling you, and the reason why I think this is so important is, as an insurance agent, one of the hardest things to see is when a family gets a lump sum of money and the money is gone quickly. I mean, yeah, you set it up for them to make sure everything was taken care of. And you're happy that you were able to help them to retrieve a certain amount of money in case somebody has lost their loved one. But the hard part is seeing the money disappear. And I stress this because both of these strategies are opening up to you more access to funds than you probably have ever thought you would see at one time. So the mindset that you need to have, the behavior that you need to have, you need to get that right before you even get into it. Most they reach out to me, they tell me how much money they get. In fact, I want to thank everybody who has reached out to me since the last podcast. I have been very, very busy, have had wonderful conversations with many of you. And the one thing that I want to point out is, if you want to have a conversation, that why is more important than anything. Don't get into either of these programs if you don't have a plan. If you need help setting up a plan to figure out what to do with it, we can do that. But don't just, oh my goodness, my house is $500,000. I could get access to, he said 90%. Please don't do that and say, I'm gonna go get a Bugatti.
Oh man, that's a bad
Don't
move.
do that to just purchase material things. That is how you end up right back broke.
Yep.
And from an insurance agent standpoint, I deal with financial literacy. I teach it at many different companies, so on and so forth. And the one thing that I oftentimes see is that there are those who will do well with very little as long as they're serious and intentional. And there are those who do terrible with a lot because they ain't serious and they're not intentional. Just kind of give you an example of that. I had a teacher. She was about 36. She was only making $38,000. Now, in this school, I had the principal as my client, many other teachers. I even had some guidance counselors. But this teacher who was making $38,000 was contributing more to her retirement than all of them. She was contributing $700 a month. When I sat with the principal said, I don't know what my check is going to be next month. Can I start off at $75?
$75.
Now, this is a person who was making $120,000 a year.
Mm-hmm.
Now, as I looked around the room, I saw a Michael Kors purse. I saw this. I saw that. I saw so many different aspects, and I said, so you want to save less than what you got on the table. You want to save less than the wallet or the purse that you have. That's not going to work. And so the mindset and the behavior, it has to be serious when you want to do this. For many of you, you may look at your finances and say, I don't have room. And then when you actually look at your bank statement, there's plenty of room when you start looking at where you're spending your money. So you have to do that first. And once again, I do budgeting conversations, all types of stuff as well. But I want to highlight this first because I want it to be very serious to you that when you decide to make a decision that can really affect your family, stick to it. Work it through. Don't just have fun.
Right.
If you want to get luxury items, get them after you got your assets that pay for the luxury items.
Thank you. Thank you. So, and that's kind of where we're gonna go with the opportunity part and this whole thing, right? How can you gain assets? And we're gonna tie it all into real estate. Real estate to me is the best investment vehicle there is when it comes to passive income, assets, and doing what we need to do in order to be able to create that generational wealth. So in part 3, that's exactly what we're gonna talk about. Again, the opportunity in the comment section. I need to know that you guys are interested in this. If not, we won't do it. Hit the like button. Make sure you guys subscribe to this channel. Tell everybody you know about this conversation. Everybody needs to hear this. Everybody's going to benefit from this. And look, we're looking to change the game for you guys. We're looking to really make this as simple as possible. This is information that can be overly complicated. We're simplifying it so that you can understand exactly what's going on. So let us know in the comment section how you feel about us doing a part 3 and presenting an opportunity for you to be able to take advantage of all of this. And we're going to see you guys on the next one. Peace.